Welcome. I'm Grant Swartzwelder with OTA Environmental Solutions, and you're here for the latest edition of Oilfield Strong. As y'all know, we post all of these on YouTube, and if you go search on YouTube under OTA compression, and you can also join to become a subscriber so you can find out when we do post new videos. Then you can go and look at not only this video, but any of the others that we've done. We will also be posting one for Michael Schellenberger that we did an interview offline, and we'll be sending an announcement about that shortly. So with that, though, I'd like to jump right in and introduce everyone to Jeremy Bishop. Been with First Capital for 17 years. He's been able to overcome his degree from Texas Tech to actually have a successful career. So there is that blind squirrel that can find a nut example here. So there you go, Jeremy. Welcome to the show. No, seriously, Jeremy's been a good friend and a work associate for quite a few years. He has had a great career with First Capital, which was just acquired by Prosperity Bank, and he has been moved into the position of regional president for the Permian Basin for Prosperity, and working to consolidate several banks in their efforts there in Midland. Active in Chamber of Commerce, his church, a variety of other things, very knowledgeable about banking. And so, with everything going on in the industry, especially from a capital standpoint, senior debt continues to be a very important thing to understand, and that's why it's great to have Jeremy on. So Jeremy, y'all are an example of this with the acquisition Prosperity just did. It seems to me that there's a lot of consolidation going on. Well, I say consolidate. There's fewer sources of senior debt out there, either through acquisitions or people just not interested in it. Tell me what's going on with all that.
Yeah, thanks, Grant. First, thanks for having me on, and appreciate everybody listening in. It's good to be able to come on and educate an Aggie. I'm happy to get that done for you. So
there you go. Just use monosyllable words, please.
Yes, yeah. No, I agree with you. I think on the topic of consolidation of banking, we've seen over the last couple of decades not only just banks acquiring smaller banks, and so we've seen a number of institutions go away, but I think additionally it's gotten harder to start a bank. I recently came from First Capital Bank, where Prosperity acquired us, and First Capital opened in 1998 as a de novo bank from scratch, and Ken Burgess was our chairman CEO there, and he started the bank because he knew some folks. They threw some money together, they filed an application and got it done. But really, when you start looking at all of the compliance and the regulatory environment in which it takes to get a bank open, the capital requirements are also much heavier to lift nowadays than they were back then. And so it's just a different environment to start new banks. So that's number one. We're not seeing as many new banks get started. But then additionally, like you said, with the consolidation, the mergers, acquisitions, those things are also having an impact on the number of banks in the country. That makes less institutions out there to fund debt, but also, on the flip side of that, we were First Capital Bank before, where our legal lending limit was roughly $30 million, and now Prosperity Bank has got us, and we can go up to several hundred million. And so we can play in different space there with Prosperity, but it's just, and we can still handle the smaller deals as well. We still have loans down to 10, 20, 50,000, 100,000, whatever the number may be that folks may need. So there are less institutions, but I do think that the capital is still there. I think that the outlet is still there for folks to get money. And if you've got a solid business plan, if you've got a prudent idea, then I think a bank's gonna, be able to fund it.
Well, and we talked about the number of banks and not being able to open, but it seems like there's other drivers potentially causing banks maybe not to be as excited about energy, which well, I'm saying that after you just said there's plenty of money out there, or there's money, not plenty, but there's money out there. But it seems like the environmental issues, the ESG issues, the the oil industry going up and down and the price cyclicality, uh, there's a lot of headwinds to banks being involved in oil and gas.
Yeah, I think, first and foremost, you need to understand the energy industry to lend to it. And that's really more of what's happened is that, banks have gotten out of the energy space when there's a downturn, and then it's just hard for them to get back into it. And so folks like us, we've been in it, based here in Midland. We know the energy space. We're comfortable with it. We can continue to do that. But I think you've really gotten a lot of these banks that have gotten out of the energy space, and it's just harder for them to get back in addition to, regulators. You have a bust, as we all know, the oil and gas industry has the ups and downs. Regulators don't like to see that volatility. And so when you start coming in and you see the volatility, if there's credits that are issued or customers that start seeing, difficulties based on the commodity prices, that becomes an issue with regulators, and they start cracking down, and then banks just end up not lending to that. But I do believe if you're especially in our case, I know Prosperity as well as previously First Capital, we were conservative enough in there that we would make sure that we had the right collateral in place, that we had the right underwriting, that we did the right structure for the customer, and make sure that we got things buttoned up nicely, if you will, to make sure that we avoid that. But yeah, in addition to those things, the government is coming in with the I think government, the regulators, if you will, coming in with the ESG initiatives. They're really, and I know we wanted to talk about that a little today too. The environmental, the governance, that kind of safety, that kind of stuff. The OCC, we've seen that really kind of start trickle down to lenders and making sure that they're checking boxes of the borrowers that are, in the energy space, that they're making sure that they're adhering to, emission standards and to, environmental, making sure that they are operating and plugging wells and doing things in an environmentally safe manner. Which
And how are you seeing that manifest itself? Is it like a questionnaire, or is it are you having to score it, or are they telling you how a bank has to look at the environmental and ESG S&G parts of it, or are they just saying, look, you need to worry about it and then you have to figure it out?
Yeah, more so than anything, it's in an exam standpoint. So they're not looking at a deal by deal credit. They're not coming in and saying, hey, if you're going to underwrite an energy credit, you have to have X, Y, and Z in your file. But it's more of concentration of portfolio, that kind of thing. Additionally, too, it's the much larger banks. So you're talking about the B of A's, the Bank of America, the Chases, Wells Fargo. Those folks are really starting to see that come through. Not so much, Prosperity is about a $40 billion bank today. We are publicly traded, so that's got some inherent risks, not risks, but I guess.
Well, more people are paying attention to you,
that's
the
right.
capital markets. So
yeah, that's right. And so we want to make sure that we're following the right guidelines, and that we're doing things that we need to, but also we're still a small fish in comparison to a lot of the others that are out there. So we haven't necessarily seen that as much yet here, definitely not at First Capital, but at Prosperity. So
is
go ahead.
that also state banks versus federal chartered?
Kind of, but really state banks are regulated by the FDIC. And then federal banks are regulated by the OCC. And so the OCC historically has been the governing entity that's come down hardest on the ESG stuff. And so Prosperity Bank is a state bank, and so we're regulated by the FDIC. And so we've not seen that as much yet. I do think we'll get there at some point. I do think that will
Yeah,
trickle.
and that seems to make sense that the federal side would be more challenging. I had a mutual friend of ours with another Midland bank had the head of the OCC come and visit with them just to introduce himself, and he brought his newly hired head of environmental evaluations or some fancy title along at the meeting. And you wouldn't think a regulator to have a environmental person hired unless they're planning on using that person. So,
Yeah.
and that seems to be for the OCC side. It's well, what? Tell me what the overall market then from lending is as far as you say there's money for the right opportunity, but I look at it and I can only come across maybe 4 names out in West Texas and Midland that would really be if I had a senior debt facility that I would go to, which seems like a very few number. Am I just not thinking about some folks?
No, I think you're probably right. But again, I think it goes back to the first point when we were talking about consolidation of banking is that you got to know and understand the industry to be able to lend to that industry. And unfortunately, there's just fewer banks that know and understand the energy space. And so being headquartered or previously headquartered in Midland and having our shop here where we, live it, breathe it every day, if you will, it provides us an advantage to know and understand it and have some experience in that space, which makes it a little easier. So that's probably why you see and you can name off the 3 or 4 or whatever in Midland that that you could go to. There are some in Dallas, there's some in Houston, there's some across, but you're also probably talking about larger institutions that are talking much larger credits, syndicated deals. Depends on who we're talking, who the audience is. Are we talking just kind of individual mom and pop working interest owners, or are we talking to big sophisticated capital backed companies, publicly traded companies, that kind of stuff? So there's differences in who we're talking about here. But yeah, I mean the credit is there. I will tell you, we'll touch a little bit on the market today with everybody's heard about regional banks and the few that failed. And, I will tell you, Prosperity is a very healthy bank, publicly traded. You can go look up their financials and see it. But what has happened, a lot of folks don't know and understand that we were in such a low interest rate environment for so long that some banks, a few banks, the ones that really kind of got into trouble and failed, really stretched for some yield. So for every dollar that comes in from a deposit standpoint, we turn around and we lend that dollar out in loans, to energy loans, to restaurant loans, to you name it. And if we're not lending those dollars, we have to earn some kind of yield on it. And so we go to the bond market. Well, when rates were so low for so long, the bond market just didn't yield much income. Yeah. And so some of these banks started going further out on that yield curve to try to stretch to reach. And then all of a sudden you wake up and the Fed starts moving interest rates on them. And now those bonds are worth less. And so that really kind of got them into trouble. There's many banks. I would guarantee you that the bank that each of you listening to this are banking with personally, those banks are not in trouble. They are looked at from a regulator standpoint. How SVB out in California got by with the bonds that the portfolio they had, the regulators knew it, looked at it, and they didn't act on it. I have no idea. But really, the everyday bank is a conservative bank. The banking system itself is healthy. But we've just got to, when rates go up like that significantly in a short amount of time, it puts a crunch on liquidity. And so banks are naturally going to start bringing in their underwriting metrics and get a little more conservative and make sure that the loans that they are lending, or the loans they are making, the borrower they are lending to, are much stronger. So that kind of circles back to you a little bit of why there may not be as much credit out there that you've seen in the past, because the deal has to be pretty stout. We've got to have a lot of equity. We've got to have, it's got to be, a very strong deal to be able to get the credit deal done. If you're talking about somebody who wants to go out and start fresh and buy some wells or start a service company or do something in the energy space, it's just that it's going to be harder to get the financial backing. And so that may be really why we're seeing less of the senior debt market for the energy loans, is because we're just having to tighten up and make sure that the deals that we are doing are credible and bank worthy.
So how does that work from, if you look over the last several years, obviously advance rates, price deck, there's different ways of adjusting for credit, but how have you seen like the percent advance or the price drop or price deck being adjusted? Kind of how's that played out either for First Capital / Prosperity or just as an industry? A lot of ways to be able to get that additional collateral that it sounds like you're looking for, but how's that changed over the last couple of years?
Yeah, it's funny. So I think back early in my career, we had a deal that we were trying to get financed, and it was too big for our bank at the time, so we had to syndicate it. And you start looking at the price deck that each of these banks were looking at. Some of them would have a $70 price deck going up to about 80 over a 5-year period. Others would be at 65 going to 75. Others would be at 85 going to 95. But at the end of the day, your price deck is set at a dollar amount there, and then you adjust. They've got different advance rates. The higher dollar price deck only had a 50% advance rate. Well, the lower dollar price decks had a 65% advance rate. And so, but there's more things that go into it as well as, what are you doing with your LOE? What are you doing with, the escalation of cost? There's so many inputs into, and then even, okay, which engineer does it and how conservative are they on the decline curve?
Right.
There's just so many inputs that at the end of the day, when you look at all of the different price decks, they all generally fall out somewhere pretty close to the same. And so that's really been not much of a focal point in my career. Now, in some cases it makes a difference, but it just really hasn't been that much of an issue. I think most everybody, and nowadays we've got these surveys where we are all kind of spot checking and making sure that we're not too far off of where the market should be on the price deck. And so we're generally all lending on the same thing. It's just going to boil down to how much equity's in the deal. What does the decline curve look like? What's the half-life of the properties? Is there a significant amount of time horizon left on the properties that are, being taken as collateral to be able to service the debt and get it cash flowed? And, if you have a hiccup and you lose a well or two, from a concentration standpoint, a wellbore concentration, we don't want to lend to somebody who's got 4 wellbores, right? We would much rather have, multiple so that we're not concentrated in that. And, I don't know if that answers your question.
Yeah, well, and no matter how you calculate it, I think I generally agree that whatever factor you do, you end up around the same value. And then you have to decide how much of that you want to, what type of coverage you want. And it seems like, based on what you're saying, that it's got to be a stronger deal, that the collateral coverage, however you calculate it, has to be, nowadays is probably a little bit more coverage than it might have been 5-10 years ago.
Yeah, I think so. And, you look at these horizontal wells and the decline curve on these is pretty steep, whereas historically a lot of the vertical older production is a lot flatter production. And so you don't really have to worry about the half-life as much on that older, shallower stuff that's, but you get into this horizontal play stuff and it really can fall off pretty quickly. And so you got to be careful. And I think too, we've learned, right? I think, we've seen some bankruptcies over the last couple of decades. We've seen some commodity price shift where the price falls out, and Okay, now lenders are a little more hesitant to reach out there and do a deal and stretch. It's going to have to be within the box. And then, you know, if you've hedged, that's certainly going to help the credit decision. If you've got a robust hedging program in place, that's going to help us get there from a credit decision standpoint. So there's just so many factors that go into it. But the bottom line is the funds are there, banks are willing to lend. And by the way, we appreciate the Fed for increasing the rate because that means we get to make a little more money on the interest, you know. So we're not overly upset at that, but
Yeah.
but no, the funds are there. The space is there. If you're having difficulty with an energy credit, I'd say check a local bank. Check a Midland bank. We're gonna have the ability and the know-how to get it done.
So you mentioned hedging. What's y'all's general policy on that as far as how much, how long?
Yeah, so a real simple question or real simple answer to that question is it depends. You know, it depends on the deal. It depends on the equity in the deal. It depends on the property type. It depends on you know, so many different variables. What does the decline curve look like? What does the concentration look like? I mean, there's just a number of variables that go into that. But at the end of the day, it's just, can we make sure that the debt gets repaid? And, you know, really the further out you go on those strips, those hedges get really expensive and then it becomes uneconomical. And so the idea is, I think from our standpoint, is let's get a landing zone. Let's get a runway, right? So if we wake up tomorrow and some country bombs another country or something happens and the price of the commodity price just falls through the floor, well, hang on a minute. If we've got hedges in place, we want to make sure that there's enough there to get us a game plan, right? To get us 6, 8, 9 months, a year maybe of, okay, how do we cut LOE costs? How do we adjust? How do we manage the property set to get down to where we can still service some debt and we can live to fight another day, if you will. That really ultimately, I think, is the goal of hedging. It's not to make sure that every dollar gets repaid on the debt, because there has to be a risk reward element there, right? And that's so expensive. If you go hedge out 3 years in advance, 4 years in advance to repay the entire debt, well, what do you need to borrow for, right? I mean, you're going to go spend all that money on hedges. So it's a balance. It really is a balancing act.
So another issue that seems over the last year or so that's become more of an interest to folks or to banks is wells that need to be plugged, uneconomical wells. And a lot of times people would just kick that can on down the road. And now all of a sudden people have stopped kicking it as much. How do y'all look at that? And how do you, you know, there's a lot of, seems like most of the properties that are turning over right now have a lot of well bores, a lot that are inactive. How do you value that?
From a banking standpoint, it's a liability, and we have to realize that and recognize that it's a liability. It may be an off balance sheet liability depending on how they're, you know, reporting it, but it is a liability. And really and truly, the Railroad Commission and the over in New Mexico, the Federal Lands Office and BLM and all those, they're doing more of the heavy lifting and making sure that these folks get some of these wells plugged. They're starting to enforce that a lot more. And the banks are realizing, and it really kind of falls into that ESG discussion we were talking about a little bit ago, of that's just that's the environment that we're in, is that these wells are going to have to be plugged. And so you start to see folks that are recognizing that, and then they're going ahead and spending the money and plugging it. But the days of just punting is no longer there, I don't think.
Yeah. The other thing that has always been interesting to me is that on most bank documents, it talks about, you know, environmental things are taken care of, and basically you just ask how I kind of see it is that the bank is asking the client to say, yes, everything is good from an environmental side. A lot of times it's not, but in a way, you're just saying, assure us that it is, and then it's up to them to make sure it is. Is that still how it's
Yeah,
going? Is that how y'all work it?
no, I mean, we want to see, phase one environmentals, we want to see evidence that there's, we kind of tell our folks it's a real estate analogy, but it still holds true in the oil and gas world. Go inspect it, go kick the tires, go look at it, we don't want our folks just lending on a house that they've never seen. We don't want lending on a property that they've never seen. Same thing in the oil and gas. Go out with the operator, run through, look at a few leases, make sure that, do a spot check. We need to make sure that from a credit standpoint, that we have addressed the environmental liability that's there. And whether we do that from a third party and have someone go do a phase one or a questionnaire or an inspection, it needs to be done, and we don't take it lightly. We really do consider those things part of the package when we start looking at funding a credit.
Okay. Another thing that's been the amount of mineral acquisitions, a number of non-op acquisitions have really seemed over the last 5 years to increase. How do y'all look at funding those type of asset classes versus just a generic operated PDP?
Yeah, so that's a good question. Actually, it's really difficult from a bank standpoint to fund non-cash flowing assets. That's typically what we are. We are a cash flow lender. We want to look to see where the cash flow is and how the debt is going to be repaid. Ultimately, that's how we're going to make our decision. And so when you're buying non-producing minerals, non-operated isn't as much of a problem as long as there's a good joint operating agreement and we know who the operator is and they've got a good history. We can do non-operated stuff as long as it's PDP and it's producing and cash flowing. But when you start talking about minerals, royalties, things of that nature that are not cash flowing, it becomes very difficult to value that and show the repayment ability in the bank. So if there's alternative sources of cash flow, as a guarantor or, a sister company or something of that nature that will help support the debt, then that's really how we're going to look at that. But those are all very good asset classes. And I have, from a bank standpoint, we've got to see the cash flow, but from an investor standpoint, it's a great asset. It's a great investment. And I know there's value in those properties. It's very difficult for a bank to lend on that.
Just might not be bankable. And so
That's
when you
right.
mentioned the bane of my existence, personal guarantee on that, is that but what are y'all requiring personal guarantees on everything now, or where's y'all's position on that?
Yeah, I'll tell you that at First Capital, we were very, very dependent upon guarantees, personal guarantees, as well as at Prosperity. I was glad to see that we were very congruent in that. It just was about the same. We need personal guarantees. And it's not so much that, okay, Grant, if I lend you the money, or if I lend your company the money and then the company doesn't pay, I need Grant to write a check for it. I get it. That's not generally the case. But what happens when you have a personal guarantee on the hook is that allows you to go to that person and say, hey, how do we work out of this? How do we get to the finish line? Do we sell it for a loss? Do we sell it? Do we try to keep it running long enough to get it sold and get everybody out? But the kicker is when you've got a non-recourse deal where there's not a guarantor behind it, it becomes and nobody likes this, but it's the fact. When you get into a situation, the principals can just walk away. There's no recourse to them. And so then the bank is left holding the asset. Well, what are we going to do with it? We're bankers. We can't go pump a well. It becomes very problematic. And then, as anyone knows, if there's a repossessed asset, you're going to get pennies on the dollar. So it's much more valuable to both the guarantor, the principals, as well as to the bank to get that property sold, to get the credit satisfied together mutually. If it's just handed back to the bank, nobody wins, but the guy that's buying it on the flip side, Um, So yeah, well, personal guarantees are really there, but again, it's not so much that we want the guarantor to just write a check. It's just we want to make sure we have a partner there to help work through it. Because honestly, if it doesn't, we're going to file a judgment and we're going to try to go collect on what we can later on, anyways. But if we can work together to get it sold for a maximum value, where the bank's not owning it and selling it, then I think really it's much more of a happy ending, I guess.
I see one of our attendees is a good friend of mine up in Santa Fe. And so it makes me wonder, with all the activity in New Mexico, there's some great rock over there, but there's also a lot of aggressive regulatory. Do you look at lending different if the asset is in Texas versus New Mexico?
We really do, unfortunately. And it's because it's harder to get things done in New Mexico than it is Texas. From a regulatory standpoint, we do letters of credit to operators for the Railroad Commission. We also do them for OCD and BLM and whatever, regulatory agency there is in New Mexico. But it's harder to deal with those state agencies in New Mexico than it is in Texas. We really, no one likes a governmental entity, but the Railroad Commission is really good to deal with. They really are. I know it's somebody overseeing what you're doing if you're an operator, and you feel like it's somebody that's overlooking what you're doing and not being reasonable. But from a government entity to deal with, the Railroad Commission is actually pretty reasonable, I feel like, from a banking side. Now, I'm not an operator. I'm not had to deal with them on that side, but from a financial assurance side, Railroad Commission's pretty reasonable. But the BLM and it's gotten to the point, not so much that we haven't dealt with them as much, but I'll tell you, we also, our borrowers are intentionally not operating in New Mexico. They're not purchasing or acquiring in New Mexico. And I use New Mexico as an example, but I mean, pick a state with the BLM,
Yeah.
same.
Well, and that's right there next to you, and where a lot of your clients might have it both places. So it's
That's right.
well, and so you're seeing, not that they're demanding a better price or you're requiring a higher yield. Are you saying that, or are you saying that they're just staying away from New Mexico as a whole?
Operators are staying away from New Mexico.
Okay, what about banks?
I don't think that banks are necessarily avoiding it, but as a byproduct of the operators and the working interest owners not buying over there, we're just seeing less of it on our books, so we're not having to deal with it over there.
Okay, so you would still lend over there?
I think so. Yeah.
Okay, that's interesting. Well, Jeremy, it is 2:04 and trying to always stay on time and always going a little over, but thank you very much for the insight that you provided on senior debt. And I put that, is senior debt even available for oil and gas? And you say it is. So I will take at your word and see how that goes. So but thanks for your time, everyone. Appreciate y'all listening in, and we'll see you this time next month. Thanks, Jeremy.
Thanks, Grant.